Welcome back to the CFO's office. In our last session, we built a ship. We designed an asset allocation strategy, a mix of stocks, bonds, gold, and cash that is sturdy enough to sail through any storm. It is safe. It is balanced. But I know what you are thinking. You are looking at that ship, and you are thinking, it is too slow. You look at the billionaires of the world. You look at the real estate tycoons. You see that they didn't get there just by saving 10% of their salary. They used a booster rocket. They used other people's money. They used leverage. Today, we are going to open the most dangerous cabinet in the CFO's office. Inside this cabinet is a tool that has created more fortunes than any other, but has also caused more bankruptcies than any other. Today, we discuss the right rules for using leverage. First, let's define leverage. Leverage is simply using debt to increase the potential return of an investment. You put down $10 and borrow $90 to control a $100 asset. If the asset goes up 10%, you double your money. If it goes down 10%, you lose everything. It is financial nuclear energy. Used correctly, it powers cities. Used incorrectly, it leaves a crater where your portfolio used to be. For the vast majority of you Inc. startups, the CFO's official policy on leverage is simple. Don't touch it. If you are a beginner, leverage is not a tool. It is a weapon aimed at your own head. When you are learning to drive, you do not start in a Formula One car. You start in a slow sedan. Leverage is the Formula One car. One small mistake, one moment of panic, and you hit the wall at 200 miles per hour. However, as you Inc. matures, as your capital grows and your skills sharpen, there may come a time when leverage becomes appropriate. But it must only be used under 3 strict rules. Rule number 1. Never match short-term debt with long-term assets. This is the most common way investors die. They buy a long-term asset, like a stock or a house, using short-term debt, like a margin loan. A margin loan is callable. This means the bank can demand their money back today. Imagine you buy a stock on margin. The market crashes 20% tomorrow. It's a temporary crash. The stock will recover in a year. But the bank doesn't care about next year. They care about today. They issue a margin call. They force you to sell the stock at the bottom to pay them back. You were right about the long term, but you went bankrupt in the short term. If you are going to use leverage, the debt must be non-callable for the duration of the trade. A 30-year mortgage is safe because the bank cannot ask for the money back just because house prices dropped. A margin loan is suicide because they can. Rule number 2. The asset must pay for the debt. This is the difference between good debt and bad debt. Bad debt feeds on you. You have to work your day job to pay the interest. Good debt feeds on the asset. The asset produces enough cash flow to pay the interest, with money left over. If you borrow money to buy a rental property and the rent covers the mortgage and expenses, that is safe leverage. The tenant is paying off your debt. If you borrow money to buy a growth stock that pays no dividends, you have to pay the interest. You are bleeding cash flow every month, hoping for a capital gain. That is speculation, not business. The CFO of You, Inc. mandates that any leveraged asset must be cash flow positive from day one. Rule number 3. Cap your leverage ratio. Greed has no natural limit. If 2x leverage works, why not 3x? Why not 10x? You must set a constitutional limit. For example, I will never borrow more than 30% of my total equity. Why 30%? Because markets can drop 50%. If you are leveraged 30%, you survive a 50% drop. If you are leveraged 50%, a 50% drop wipes you out. You must assume the worst-case scenario will happen. Because eventually, it will. Now let's talk about the psychological cost of leverage. Debt destroys patience. When you trade with your own cash, you can sit and wait for years. You are calm. When you trade with borrowed money, the clock is ticking. You are paying interest every day. You become impatient. You become emotional. Leverage lowers your IQ. It makes you panic faster. It makes you sell at the bottom. The CFO knows that a calm mind is the most profitable asset. Leverage disturbs that peace. So here is the verdict for you, Inc. If you are in the accumulation phase, if you are still filling your buckets, stay away from leverage. Build your foundation on solid rock, not on borrowed sand. If you are an advanced investor, apply the rules. No margin loans, no short-term debt. Cash flow must cover interest. Strict limits on the ratio. Remember, the goal of you, Inc. is not to get rich quick. It is to get rich surely. Leverage offers speed, but it sacrifices certainty. And in our business, survival is the only metric that matters. We have now discussed how to allocate assets and how to manage the dangers of debt. We are managing the buy side and the hold side. But what happens when an investment goes wrong? What happens when a division of your company starts bleeding money? In the corporate world, a CEO shuts down a failing factory. He fires an incompetent department. In the investing world, we call this a stop loss. In the next episode, we are going to discuss the hardest emotional challenge for any investor. We're going to talk about stop loss, cutting off non-performing divisions. We will learn how to admit defeat, fire the losers and protect the rest of the company, pay off your credit cards, cancel your margin account. I'll see you in the next video.